You are listening to a featured author on Ex Libris Podcasts.
The book is called Winning Investment Decisions. The author is Dr. Walter Wild. Dr. Wild, do you have any guiding principles when it comes to investing, and what are they?
I do. I have several. First, I invest with a long-term horizon. I like to look ahead by about 15 to 20 years. Short-term changes are whimsical and harder to predict than long-term, as market prices tend to fluctuate around a normative valuation of intrinsic worth. Fear and lure can pull the price below or above, but in the long run, the price will tend to reflect the intrinsic value of the investment. Secondly, I like to gather all the information needed to know the issue's underlying value, the issue that you're considering, that is, the bond's yield, the security, bonds yield and security, the stock's safety, yield, earnings growth, and persistence. Get your information from companies engaging in selling advice and data, such as Value Line Investment Services or Standard & Poor's, and not on firms selling securities, as they may have a hidden agenda. And thirdly, buy only when the cost is appropriate to the basic value. You can find the basic value from the information you've gathered, and you can apply it with the various formulas you can find in my book to find the basic value. Diversify across both industries and locations. Diversification decreases risk, but if carried too far, it will blunt gains. And I invest with an eye to safety. Invest for persistently growing capital and stream of income with that eye to safety. Then I would maintain sufficient liquid reserves so that if the market reverses, you can see yourself through it without having to sell when the market is low. Know yourself and invest according to your temperament and your relative desires for safety, income, and capital appreciation. Those are my basic principles.
Dr. Wild, there are investment decisions that are made based on false myths, and I think both amateurs and professionals make that mistake. What are some of those false myths?
Well, one is that gold is a hedge against inflation. Since the 1970s, when gold's link to the dollar was severed, the correlation between the price of gold and inflation has been zero. So there is no hedge. But gold can be a refuge from a soaring inflation and panic. It can be seen as a panic barometer. Another myth is that savings accounts are risk-free. Inflation almost continually drains their value. When one combines the taxes on their interest and inflation, they may be losing value. There is also the possibility of bank collapse. Next, some people think that stocks are for gambling and therefore stay away from them. Across the 20th century, index stocks have been less risky than any form of investment except land. But handled recklessly and when using leverage like buying on margin and short selling, stocks can be very risky. Again, some people think that if they have an insider's tip, they have a guarantee of success. But the tip may be wrong. Some insiders like to treat likelihood as fact. And even with an accurate tip, as others almost certainly will have heard or guessed before you, the market may have already adjusted before you act. If you then sell short, those who acted earlier will now cover their short sales, causing a reversal and loss for you. And then some brokerage firms and investment advisors use the idea of certain predictors, like the January predictor has been frequently touted, put forth, even though it has been shown to be false. Kondratiev wave is used by some, but is a non-validated hypothesis. That's what I have to say about myths.